What if I told you just 15 great stocks could make you incredibly wealthy, and that most people fail simply because they don't know what to look for? Today, we're unlocking the timeless investing secrets from Common Stocks and Uncommon Profits by Philip Fisher, a book that influenced legends like Warren Buffett. Welcome to Money Library, where we break down powerful financial books into simple ideas you can actually use. In this video, we're diving into Common Stocks and Uncommon Profits, a classic that focuses not on quick wins but on building long-term wealth through smart investing. Philip Fisher introduces a completely different approach to investing, one that focuses on quality over quantity. 1. Invest in great companies, not just cheap stocks. Fisher's philosophy challenges one of the most common mistakes investors make, chasing stocks simply because they look cheap. A low stock price or a low price-to-earnings ratio might seem attractive on the surface, but Fisher argues that these metrics often hide deeper problems, such as slow growth, weak leadership, or a lack of innovation. Instead, he shifts the focus toward identifying exceptional businesses, companies that have the ability to grow consistently and dominate their industries over time. According to Fisher, a great company usually has a few defining characteristics. First, it offers products or services with strong future demand, something that isn't just relevant today but will continue to be needed or even expand in importance in the coming years. Second, it invests heavily in research and development, constantly improving and staying ahead of competitors. Third, it has a strong competitive advantage, something that makes it difficult for other companies to replicate its success, whether that's technology, brand reputation, or operational efficiency. Another critical factor Fisher highlights is scalability. Great companies don't just grow, they grow efficiently. This means they can increase revenue faster than costs, leading to expanding profit margins over time. He also stresses the importance of capable and ethical management, because even the best business idea can fail under poor leadership. Leaders who think long-term, reinvest wisely, and maintain transparency are essential for sustained success. Fisher also introduces an important mindset shift. Instead of trying to buy low and sell high quickly, investors should be willing to pay a fair or even slightly high price for a truly outstanding company. Why? Because if the business continues to grow for years or decades, the initial purchase price becomes far less important compared to the massive long-term gains. In fact, many of the world's most successful investors, including those influenced by Common Stocks and Uncommon Profits, have built their wealth by holding on to high-quality companies for long periods rather than constantly searching for bargains. Ultimately, Fisher's message is about thinking like an owner, not a speculator. When you invest in a stock, you're buying a piece of a real business. So instead of asking, "Is this stock cheap?" the better question becomes, "Is this a company I would be confident owning for the next 10 to 20 years?" That shift in thinking is what separates average investors from truly successful ones. 2. The Scuttlebutt Method. One of Fisher's most unique and powerful ideas is the Scuttlebutt Method, a strategy that goes far beyond simply reading financial statements or analyst reports. Fisher believed that the best investment insights come from real-world information, gathered by talking to people who actually interact with the company. This includes employees, former employees, customers, suppliers, competitors, and even industry experts. The goal is to build a complete, honest picture of how a company truly operates, something numbers alone can't always reveal. For example, instead of just looking at a company's revenue growth, Fisher would suggest asking customers, "Do you genuinely like this product? Would you buy it again? Is it better than competitors?" Similarly, speaking to suppliers might reveal whether the company is efficient and reliable, while conversations with competitors can provide insight into how strong or vulnerable the company really is in its market. This kind of qualitative research often uncovers hidden strengths or weaknesses that are not immediately visible in financial reports. Fisher emphasized that this method requires curiosity, patience, and a bit of detective work. It's about connecting small pieces of information from different sources to form a bigger, more accurate picture. While no single opinion should be taken as truth, patterns begin to emerge when multiple sources point in the same direction. That's where the real value lies. Another key advantage of the Scuttlebutt method is that it helps investors gain conviction. When you deeply understand a company, how it operates, how people perceive it, and how it competes, you're far less likely to panic during market fluctuations. Instead of reacting to short-term price drops, you can rely on your research and stay focused on long-term potential. In essence, Fisher teaches that successful investing isn't just about analyzing data, it's about understanding businesses at a human level. By doing the extra work that most investors avoid, you can discover high-quality companies early and invest with confidence. This approach, introduced in Common Stocks and Uncommon Profits, remains one of the most practical and underrated strategies for serious investors even today. 3. Focus on long-term growth. Fisher strongly believed that the biggest money in investing is not made through frequent buying and selling, but by holding on to great companies for a long time. Many investors get distracted by daily price movements, market news, or short-term trends, constantly trying to time the market. Fisher argues that this approach often leads to missed opportunities and unnecessary losses. Instead, he encourages investors to shift their focus toward the long-term growth potential of a business. The idea is simple. If you've done your research well and invested in a truly outstanding company, time becomes your greatest advantage. As the company grows, expanding its products, increasing its market share, and improving its profits, the value of your investment compounds. What may start as a modest return can turn into extraordinary wealth over years or decades. This is the power of compounding, and Fisher believed it works best when you stay invested. Fisher also warns against selling too early. Many investors make the mistake of selling a stock after it rises by 20% or 30%, thinking they've made a good profit. But in reality, they may be cutting off the opportunity for much larger gains. Great companies often continue to grow far beyond initial expectations, and by selling early, investors lose out on the most powerful phase of wealth creation. Another important aspect of long-term investing is patience during downturns. Even the best companies experience temporary setbacks, market crashes, economic slowdowns, or short-term declines in performance. Fisher emphasizes that these fluctuations are normal and should not shake your confidence if the company's fundamentals remain strong. In fact, such moments can be opportunities to invest more. Ultimately, Fisher's message is about discipline and perspective. Instead of asking, "What will this stock do next month?" the better question is, "Where will this company be in the next 10 or 20 years?" By focusing on long-term growth and staying committed to high-quality businesses, investors can harness the full power of compounding, an idea central to Common Stocks and Uncommon Profits, and one of the most important principles for building lasting wealth. 4. Strong management matters. Fisher placed enormous importance on the quality of a company's management, believing that even the most promising business can fail under poor leadership, while an average business can become exceptional with the right leaders. According to Fisher, when you invest in a company, you are not just investing in its products or financials, you are investing in the people running it. Their decisions, vision, and integrity ultimately determine the company's long-term success. Great management, in Fisher's view, is defined by several key traits. First, they have a long-term vision. Instead of focusing on short-term profits or pleasing shareholders in the next quarter, they make decisions that strengthen the company over many years. This includes investing in research, expanding intelligently, and building a sustainable competitive advantage. Second, strong leaders are honest and transparent. They communicate clearly with investors, admit mistakes when necessary, and avoid misleading information, building trust over time. Fisher also emphasized the importance of management's ability to adapt and innovate. In a constantly changing business environment, companies must evolve to stay relevant. Leaders who encourage innovation, listen to new ideas, and respond effectively to challenges are far more likely to keep their companies ahead of the competition. Additionally, he looked for management teams that could build strong internal cultures, where employees are motivated, productive, and aligned with the company's goals. Another subtle but powerful point Fisher makes is that good management allocates capital wisely. They know when to reinvest profits into growth, when to expand operations, and when to hold back. Poor capital decisions, like overexpansion or unnecessary spending, can destroy even profitable companies. Ultimately, Fisher teaches that analyzing a company's numbers is not enough. You must evaluate the people behind those numbers. By identifying businesses led by capable, ethical, and forward-thinking leaders, investors greatly increase their chances of long-term success. This principle, highlighted in Common Stocks and Uncommon Profits, reminds us that great companies are built by great people, and those are the investments worth holding on to. 5. Don't over-diversify. Fisher challenged the traditional advice of spreading your money across a large number of stocks. While diversification is often promoted as a way to reduce risk, Fisher believed that over-diversification actually reduces your chances of achieving outstanding returns. Instead of owning 20, 30, or even more stocks, he argued that investors should focus on a small number of carefully selected, high-quality companies that they truly understand. The logic behind this is simple. Your best ideas should get your biggest attention and your biggest investment. If you've done deep research and identified a truly exceptional company, spreading your money too thin across many average investments will dilute the impact of that great decision. In other words, even if you pick a winning stock, it won't significantly boost your portfolio if only a small portion of your money is invested in it. However, Fisher was not suggesting reckless concentration. He emphasized informed concentration, meaning you should only invest heavily in companies you have thoroughly researched and have strong confidence in. This ties directly back to his Scuttlebutt method and focus on quality businesses. The more you know about a company, the more comfortable you can be allocating a larger portion of your portfolio to it. Another key point is that over-diversification can create a false sense of security. Many investors believe owning many stocks automatically protects them, but if those stocks are poorly chosen or lack growth potential, the overall portfolio may still underperform. Fisher believed it's better to own a few outstanding companies than many mediocre ones. That said, some level of diversification is still necessary to manage risk. Fisher didn't advocate putting all your money into a single stock, but rather maintaining a balanced portfolio of a select few high-conviction investments. In essence, Fisher's message is about focus and conviction. By concentrating your investments in businesses you truly believe in, you give yourself a better chance to achieve exceptional returns. An idea strongly emphasized in Common Stocks and Uncommon Profits, and one that continues to guide some of the world's most successful investors. 6. Avoid emotional decisions. One of the biggest enemies of successful investing, according to Philip Fisher, is not the market, it's your own emotions. Fear, greed, excitement, and panic often drive investors to make poor decisions at exactly the wrong time. Fisher emphasizes that mastering your mindset is just as important as analyzing companies, because even the best strategy can fail if emotions take over. A common example is fear during market downturns. When stock prices fall, many investors panic and sell their holdings to avoid further losses. But Fisher argues that if the fundamentals of the company remain strong, these temporary declines should not be a reason to exit. In fact, they can present opportunities to buy more of a great business at a better price. Selling in fear often locks in losses and prevents investors from benefiting when the market eventually recovers. On the other hand, greed during bull markets can be equally dangerous. When prices are rising rapidly, investors may chase stocks without proper research, driven by the fear of missing out. This often leads to buying overhyped or overvalued companies, which can result in significant losses when the excitement fades. Fisher also highlights the importance of having a clear investment strategy and sticking to it. When you've done thorough research and truly understand a company, you are less likely to be influenced by daily market noise or sensational news. This helps you stay calm and rational, even when others are reacting emotionally. Discipline is the key here. Successful investors develop the ability to separate feelings from decisions. They rely on logic, facts, and long-term thinking rather than short-term reactions. This doesn't mean ignoring risks, but it does mean evaluating them objectively instead of emotionally. Ultimately, Fisher teaches that controlling your emotions is a major competitive advantage in investing. While most people react impulsively, those who remain patient and rational are the ones who succeed over time. This timeless lesson from Common Stocks and Uncommon Profits reminds us that the market rewards not just intelligence but emotional discipline. So, here's a question for you. Would you rather invest in many average companies or a few exceptional ones and hold them for the long term? If you found this helpful, don't forget to like, share, and subscribe to Money Library for more powerful book summaries that can transform your financial future.